All right, let's get right into it. If you've ever traded anything, stocks, crypto, whatever, you know the real fight isn't with the market. Nope. The biggest, toughest battle you'll ever face, it's the one happening right inside your own head.
So here's the question that drives every trader crazy. Why, oh why, do we do this? You've got a winning trade, it's going up, but you get jumpy and sell for a tiny profit, only to watch it rocket to the moon without you. Even worse, you're on a losing trade, and you just hold on. You hope, you pray, you tell yourself it'll come back, all while that hole in your account gets bigger and bigger. This isn't just bad luck, my friend. It's a very specific, very human psychological trap.
I love this quote. It comes from aviation, but man, does it hit home for trading. The market? That's the storm. It's going to be wild. It's going to be unpredictable. But here's the thing. The storm itself isn't what takes you down. It's the panic. It's how you react when things get turbulent. That is the real danger.
So how do we start to understand these reactions that feel so irrational? Well, the answer is in this amazing field that smashes psychology and economics together. Welcome to what I like to call the real financial battlefield, behavioral finance.
So what is behavioral finance? You know, traditional finance assumes we're all these perfectly logical, calculating robots. But behavioral finance gets real. It says, hey, we're humans. We're driven by feelings, by biases we don't even know we have, and by mental shortcuts that lead us to make the same mistakes over and over again. It's all about figuring out the why behind our money decisions.
Okay, so let's pull back the curtain and meet the hidden culprits behind our biggest trading blunders. Think of these as the little gremlins in your brain, the subconscious triggers that are quietly steering you right off a cliff. First up, the big one, loss aversion. Get this. Research shows that for most of us, the pain of losing, say $100, feels about twice as bad as the pleasure of winning $100. So your brain isn't really wired to make you rich, it's wired to desperately avoid that feeling of pain. And that right there, that's why we cling to losing trades. We're not holding for a comeback, we're just trying to avoid the pain of admitting we lost.
Next up, we've got anchoring bias. This is when your brain gets latched onto a number, usually the price you bought at, and refuses to let go. You bought a stock at $50. Now it's at $30. All the new information, all the charts, everything is screaming, get out! But your brain is anchored to that $50 price tag, just hoping to get back to even. It makes you totally blind to what's actually happening in the market right now. And when you mix loss aversion with anchoring bias, what do you get? You get the disposition effect. This brings us right back to that question from the beginning. We sell our winners way too early just to grab that quick hit of pleasure and avoid the pain of it turning against us. And we hold our losers forever because we're anchored to our entry price and we're allergic to the pain of taking a loss. It's a brutal 1-2 punch.
And you might be thinking these biases all sound kinda similar. But the way they trip us up is actually pretty distinct. Anchoring, like we said, is all about getting stuck on that first number you see. Then you've got confirmation bias. That's when you only look for news that agrees with your decision, completely ignoring all the warning signs. And then there's the framing effect, which is all about how information is presented. A 90% survival rate sounds a whole lot better than a 10% death rate, right? Same exact fact, totally different feeling. Each one is its own unique mental trap.
Okay, theory is great, but is there any hard proof that managing your emotions actually makes a difference in your results? Well, you're in luck. A really cool study decided to look at just that by comparing two very different types of market players.
So this study from 2023 took a group of long-term investors, think Warren Buffett style, and a group of short-term speculators, the high-frequency, high-risk traders, and they measured their emotional intelligence. And what they found, well, it was pretty mind-blowing.
Just look at these scores. I mean, come on. In things like emotional stability and self-motivation, the investors just blew the speculators out of the water. It shows that investors had that emotional control to stick with a plan, while speculators were way more likely to make those impulsive, emotional moves.
And this chart just puts it all in perspective. The total EI score for investors was over 106. For speculators, barely 67. The takeaway here is huge. Your ability to manage your emotions isn't some fluffy, nice-to-have skill. The data shows it is a massive, massive advantage.
All right, let's take this a step further. We've talked psychology, now let's talk biology. What is physically happening inside your brain when you're staring at the screen about to make a huge, risky trade?
This is what risk literally looks like inside your brain. It's incredible.
Using fMRI scans, scientists can now watch this battle play out in real time. When traders are making these high-stakes calls, the emotional centers of the brain, the parts that judge value, and the reward centers, they all light up like a Christmas tree. It's a full-on neurological tug-of-war.
Okay, we've seen the problem, we've seen the biases, we've even seen the brain scans. So what in the world do we do about it? Let's stop talking about the problem and start building the solution. It's time to build your mental toolkit.
All right, here is a super practical tool you can use the next time you feel yourself getting emotional. You know, like when you're about to make a revenge trade. It's called the 3-minute reset. Step 1, name the emotion. Literally say out loud, I am feeling angry. This helps kick the logical part of your brain back online. Step 2, step away. Get up, walk away from the computer. Break the state. Step 3, box breath. Breathe in for 4 seconds, hold for 4, out for 4, hold for 4. Do it a few times. It physically calms you down. And finally, step 4, ask one question. If I were having a great day, would I still take this trade? If the answer is no, you're done. Walk away.
And for the long haul, you need to build discipline through rules. These are your non-negotiables. Keep a journal, but don't just track your trades, track your feelings. Use automated stop losses to take your ego out of the decision. Focus on your process, not just whether one trade won or lost. Have crystal clear goals written down before you even think about trading. And most importantly, trust the data, not your gut. These rules are your armor. They protect you from yourself.
So at the end of the day, look, the goal isn't to become some emotionless robot. That's impossible and probably not even helpful. The goal is to be disciplined. It's to make sure your emotions are in the passenger seat, not grabbing the steering wheel. So I'll leave you with this question to think about. The next time you're trading, are you really trading the market? Or are you just trading your own hopes and fears? The answer to that, well, that could change everything.